Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Well, good weekend, all. Ira Epstein of Linn Associates with your agriculture update for this Friday, and we are now at the 22nd of March, 2018, and this is your weekend edition. Now, in the weekend edition, I do things a little bit different. We'll first look at one monthly chart, and then everything else is going to be weekly charts. The one thing we know is that agriculture's in the crosshairs of China. Now, have they tariffed anything yet? Not that big, okay? It's going to happen. Remember, the tariffs that China's right now threatening America with and announced today have to do more with steel and aluminum that we put the tariffs into place today. Actually, today, I think it's today or tomorrow, that the first days that you have to start paying the U.S. for on imports that are going to have the tariffs. And then as the U.S. grants exclusions, you'll get that money back if you were one of the countries excluded. China, you won't be involved in that. You're going to not have an exclusion. So now the markets are getting fearful about pork, not so much beef because we don't send that much there, but certainly soybeans. Yet in the soybean market, as everybody thought about it, you dropped to 10.09 today, rallied back up to nearly unchanged. That was very, very impressive. You had a 14-cent rally in the wheat and almost a 10-cent rally back in the corn from the lows. Pretty volatile day, and the market not falling apart on the news where we realize that soybeans will be one of the markets that they look at. The problem is, as I wrote in my report last night, you can go to South America and try to get all the beans you want. Have a good time. Let's assume they sell you everything to make up the U.S. Then they can't service their other customers. They only have so many. We're the big elephant in the room with it. Brazil will be. But they're just behind us at this point. They need to clear more land and do whatever they do. We've got it, and that becomes the problem. And the market realizes that to a degree. In fact, the meal market was what led the market back with gains today. As you can see on a monthly chart, while you've had a correction and you are down for the week, for the month, let me say that right, 16.75 cents, you haven't really stopped anything on this gradual upthrust, and you're still over the 18-month moving average of closes of 983.75. We're going to have next week, I believe it is next week, we get our crop numbers, and I think that's going to be a very, very volatile day in the trading. Remember, then we have Good Friday right after that. If you take a look at the weekly area chart of closes, I'm going to call the market thrusting down on the weekly. You've gone from 1071 under this most recent low. The bias is up because you're over the 18-week moving average of closes, and support there's at 994.5. But if you look at the theory of making lower highs and lower lows, you've got momentum to the downside that way. When I come to the weekly bar chart, you can see how the market is slipping back a little bit. And when I put the swing lines on it, you have not violated a trend on the weekly chart. You still very much have the pattern of higher lows and higher highs. Take out 967.75 right now, that would break it. Or develop a new pattern that creates something. But right now, that's the number you'd have to break. So where's the support? The combination, I think, of the 100-day average and the 18 is your support between 998.5 and 994.5. And if you get there, you still haven't violated that 967.75. So I would not be surprised if you extended the break to see the support there. That's an if you extend the break. The rally has taken this sideways action. Remember, if I take all this away, here's all this sideways action. And the question is, which way was the market going to try to break out? You kept hitting what I call the neutral number, the 18-week moving average of closes, and you went sideways between the top and Bollinger Band. In order to break out, you've got to either get up and over the band and start pushing it higher, or get under it and push it down. The pattern right here was you made your move, and this was on February 16th to the upper part of the band. The question always is it a one-time move and then you pull back in it? Well, as you can see, it got through it and then it leaned back on top of it. It then started running with that right on the way that you're doing, and this is your first couple of weeks where you're getting a correction. You have not done anything except expanded the range of the market higher, not lower. A lot of that was due to what? The bad weather in Argentina. Remember, drought conditions there? Think about that. Momentum-wise, you're getting divergence now. You've got momentum turning down. The red number, the K, is under what's called the D line in slow stochastics. Just think of them as two numbers that do this with themselves. And when the red gets under the blue, momentum is turning down. So I've got momentum turning down. I have the bias of the market up since I'm over the 18-week average of closes, and I still have a bullish pattern of higher lows and higher highs. That's why it's called divergence. When you go to the meal market, I think today was really important. This market came roaring back, and we have now what's called an outside week up, which often, the way I teach my charting course, is a trigger for you to start understanding something. This means that if the market continues fine and dandy, maybe it gets back to the 394.40 level. But if you take out the low of an outside week up, my rule of thumb, it's mine, I'm not telling you it's going to work or not, but I certainly adhere to it, is that when that occurs, prices often go to the nearest Bollinger Band or moving average. In this case, it's the closest. It would be the 18-day average of closes. So I would be telling my clientele as a chartist, that's the number you don't want to take out until that's taken out. The trend is up. You have divergence because you're now putting that red line back under the blue, and you still have the swing line higher. In the soybean oil, this is still bearish, just plain out bearish. Lower highs, lower lows, momentum pointing down, bias down. Nothing at all friendly on that chart. In the corn market, you had made a run, and let's go to this. And a lot of this is, again, due to the problems that we saw in South America, especially Argentina, where they have the drought. You were over the 18-week average of let me say this right. You closed under. The 383.5 was the upper Bollinger Band. You closed under it that week. The week before you were over. The week before you were over, and on this week you closed under. So you had 2 weeks in a row over. It gives you a 3% chance, because my rule of thumb on this also is that Bollinger Bands work on the theory that 95% of the time the market will trade within the bands. As I've done my research, I've discovered that successive weeks or days take away one of those percentage points as a rule of thumb. So that would leave me, because I have 2 successive over it, 3% chance. Now the market at this week closes under it. You're back to square one. And as it turns out, that also began this correction that you saw in the market where you're at right now. You have momentum turning down. You've got, right now, the market sitting where the 18-week average and the 100 are sitting literally together. Support back at that number. You're going to get what's called a bullish crossover when we reopen Sunday night. On the weekly chart, the 18-week will jump over the 100-week. Just think of the math and you'll understand how that you can figure that out. In the wheat market, momentum down. The market had a couple of weeks over the upper Bollinger Band, backed away. Same theory. You've took the trading range up, not down. Now you got momentum down. If you take out 444, watch out. That means a challenge probably of the 18 and 100-day average will happen. Now, when we did get a bullish crossover here, I want you to look at this. Here you've got the 100-week average and the 18-week. Still, the 18-week is under the 100. You get your crossover. Now, the market's in its uptrend, and it gives it up. It didn't even make a new high on that. That's disturbing. When you don't get a new high off those type of crossovers, it's a warning sign that maybe price ran ahead of the momentum. I don't know. But I'm looking for the support here. What I don't like is to get to the support, you've got to break the uptrend of higher lows, higher highs. Cocoa market still bullish as can be, running that upper Bollinger Band. A lot of problems that they're looking at in the new cocoa crops that are coming in. And look at how this market from this base, and this is what you always look for. Look for the sideways action in Bollinger Bands. they're a telltale that something is going to happen. The trick, of course, in trading is to catch whatever that is, and sometimes option plays, if there's liquid options, are the way to go. This market went up first, stalled at its 100-day and its upper Bollinger Band on March 2nd, and it has been running since, and it's been merciless. Now, here too you have an outside week up, so you know what I'm going to say. Take out this week's high, and it's a sign the market probably is a bit overdone. Be careful then. Sugar market, maintaining its bearishness, lower highs, lower lows, running against the lower Bollinger Band, momentum still pointing down. Coffee market. The coffee market has still got the pattern of lower highs, the lower lows, momentum pointing down. Resistance, the 121.48 level, let's call it 121.50, the 18-week moving average of closes. Cotton market, again, peaked out against the upper Bollinger Band. Now, if you didn't know anything else, you come down for support at the 18-day average. I'm not saying you always go back up to that, but you certainly have your eyes wide open, and that is a potential resistance point. And the market's coming up at you. There's no reason, by the way, to be short when you're over the 18-day average. Another thing I teach in my charting course. I use that 18-day average as a filter on what you're looking to do. I have no interest in the way I teach trading, my teachings, to try to tell you, be short here to buy it there. I'm more interested in buying it here to get out at Bollinger Bands. Buy it again if that's what you're doing. Not being short when you're over that. I need, how do I say it, filters on the different indicators. Now, the cattle on feed report came out bearish today. That's all that's important. If you get our research, you'll see everything that came out. The market this week, if you take a look, got under this low. So now you got a higher high, a lower low. Notice how the market stopped right at the 100-week average. Now you have a bearish report. In theory, at least, if you're going to get follow-through, you're starting to target the lower Bollinger Band, and momentum is pointing down. The hog market, well, everybody's hearing that China's not going to buy U.S. pork or different cuts of pork and so on and so forth. Lower highs, lower lows, bearish, maybe overdone, getting under the lower Bollinger Band. It's got to prove itself that it can stay under that. Most traders that I talk to and teach my trading to, I tell people you don't buy over Bollinger Bands or sell under them. It's not a trade recommendation, but if you do that, often you can find that you can come in better than that. Can you get some situations where a market gets away from you? You can. There's no question about it. There's nothing that's bulletproof. But if you put good trade practices with monetary risk into place, it's better than not having them. That's what I can tell you. Want to remind you about my research. Now, we've brought up something new that's turned out to be popular, we think, for our subscribers. Some subscribers really don't want the trade recommendations. They want the synopsis that I write in the morning and in the evening, because I cover the USDA, I cover government reports, I cover Trump. I give you a synopsis that you can read quickly, you get the points, and I also talk about the morning reports that are coming out, what the market often expects, and then update them for you when they come out, what the trade thinks of them, and so on. That is but $25 every 30 days, $20 if you do it on a yearly basis. Now, let's be honest, okay? For not even $1 a day, that's pretty good. You're getting an awful lot. If you want the trade recommendations with it, yeah, it's 3 times as much on a monthly basis. It's $60. Open up a trading account with us. Then with the trade recommendation, falls to $40. Just go to our website. You'll find out all about the different products that we have. Why not avail yourself of it? You're spending more on coffee on a month than you are getting some of this research. Maybe I give you a good idea. I'm Ira Epstein. You have a good one. Have a great weekend, and I'll see you Monday.